Start record. Okay, so this is the second class for our module. I just want to quickly check, have everyone looked through the lecture 2A? So in the last lecture, which is kind of 2 weeks ago, we ended by saying that there will be a recorded lecture because this part, lecture 2, is quite long and we will not be going through the case study. So this is the lecture 2A. Oh, perfect. Thanks for watching it. Yeah. So I hope at least maybe 50% of you all have did it. Yeah, because this is whatever we went through last lecture. However, now it is in a case study form, and this case study, of course, is quite relevant to your group project, right? In terms of like how it will be structured. So at the same time, I also included some review slides. So because what we're covering today would rely on knowledge from the past. So particularly more of your like basic finance kind of knowledge, like what's expected returns, and also it is more of a recap. These are additional to the syllabus, right? Or additional to the study guide. So these are more recaps. So I hope you are familiar with all this now, because this is our portfolio stuff, which is covered in, I think, year 1 or year 2. Okay, so I'll not be going through this. However, are there any questions relating to lecture 2A? Feel free to put them in a group chat, or if you like, you can unmute yourself as well if it's easier. So I guess no questions. So before we start, I hope everyone have tried to get in touch with your GBA group members. So if you do have any issues, do not hesitate to reach out to me. At the same time, if you have not seen the announcement, I posted the GBA groupings as well on our tutorial site. So have a look at what it is. And if there are some mistakes also, you can reach out to me, right? Okay, so now we are here, lecture 2. All right, so I guess everyone is comfortable, no questions relating to lecture 2A. Yeah. Okay, so now let's proceed to lecture 2B. So let's do a quick overview again, as like what I like to do, what we covered previously, right? So in the last lecture, we really focused on this thing called the IPS, right? The investment policy statement, and we went into really small details about what the IPS should consist, and then we go into all the various details that we should include, and then after that, what we did is we move on to who are our clients. And when we talk about clients, because we are always taking the stand of, okay, I am a maybe wealth manager, I am a portfolio manager. So how am I supposed to tackle very unique aspects of various clients, right? So our clients can be, initially we were talking more of like individuals, but then later we discover that, oh, you know what, our clients could be like insurance company, our clients could be institutions, banks, etc. So we went to that detail of understanding the uniqueness of each client, and then as we conclude, we kind of say, okay, if we have certain kind of clients, then we need to craft our IPS to meet the client's needs. So, and the needs, of course, based on the purpose of his investment, right? So his what does he want? What kind of returns? We talk about risk. We covered quite a bit of stuff, right? And then in lecture 2A, we covered more of a case study of how actually how is in real life when you actually be presented with lots of information from a client, and then you have to kind of dissect the information and write a IPS. And so this is, of course, very relevant for a group project as well. As some of you all might have already, just flip through and have a look. It is also a very long case study, as well as, in fact, you can actually start doing your group project because we have covered the IPS, and the group project covers lecture 1, if I'm not wrong, 1 to 4 or 1 to 6. Sorry, 1 to 4, I think. So basically, you can really start with the first part on lecture 1, which is the IPS, right? And as we go, by the end of today's lecture, you can cover even more of your group project as well. So highly encourage you to do the group project as the lecture goes along, because what you realize is that for this module, a lot of the knowledge is built on each other. So whatever we covered today is kind of built on to lecture 1, right? So at the end of the day, what we're doing is portfolio management. And so portfolio management starts with the IPS. And now what we're talking about in today's lecture is this thing called modern portfolio theory. So in lecture 2A, we covered the basic portfolio theory where you have 2 stocks. We talk about things like, we have beta risk, which is systematic risk, and we have unsystematic risk, right? So unsystematic risk can kind of all can be diversified away by putting stocks in a portfolio. However, we do have beta risk, which is a systematic risk that is present in our portfolio. And so now what we are trying to tackle is, let's try to understand deeper in terms of this portfolio theory. So yes, we're still going to talk about correlation, we're still going to talk about covariance. However, let's try to understand it in more detail so that when we plan a portfolio for our client, we know what to put in the portfolio, right? So that's the overview. So we are going to really dive deep into modern portfolio theory, and that's more or less 2/3 of our lecture. The last part of our lecture, we're just talking just a touch and go on asset allocation, because in lecture 3, we're really going to dive deep into asset allocation. So we're going to do calculations of asset allocation, how you see the interactions in the in allocating assets properly. Okay, maybe I pause here. Any questions, any concerns before we dive into modern portfolio theory? No, we're good. All right, perfect. Okay, very good. So let's think about the overview of modern portfolio theory. So portfolio basically is like a aggregation of stocks, right? We have a lot of stocks inside a pot. So as you will see, a portfolio can be efficient. Okay, let me just pull out my pen. So this is lecture 2. Yes, this is lecture 2. It is lecture 2B because there is a lecture 2A that is already uploaded after the last lecture. And hopefully you have looked through lecture 2A, because that's a mandatory kind of recorded lecture. Okay. All right. So efficient portfolio. So in an efficient portfolio, is the portfolio with the highest expected return for a given volatility. So this is important because at the end of the day, we know that risk and rewards are kind of not very proportional, but they are related, right? The more risk you take, the more rewards you get. So for a given volatility, and anyone can understand where does volatility comes from. What's the measure of volatility? Anyone remembers? In lecture 2A, we covered that. So how do you measure volatility? Or we can call it total risk. Yes, that's right. Perfect. Thanks for the answer. SD, that's right. So those that maybe forgot to watch lecture 2A, so SD is standard deviation. So standard deviation measures total risk, and we know your beta measures systematic risk only, right? So SD measures systematic and unsystematic risk, which is what we're going to focus on today. And so efficient portfolio has the highest expected return. Inefficient, of course, it's not very efficient, less return, right? For given volatility. Now, we have this thing called an efficient frontier, and this word frontier is important because we're going to see like a graph in the next few slides, and we'll see where the frontier is, right? And the frontier is focused on what? The northwest portion. So I'm going to put a star here, northwest portion of the curve. Okay, so just hold that thought for a while. Let's go to this example here, and we'll see a graph, and then you straight away understand what's northwest portion means, and what's this efficient frontier that we're talking about. Okay, so in this example here, we have a two stock portfolio. So just two stocks. We have Intel and Coca-Cola. All right. In this portfolio, what we have plotted is the various weights of each stock. So one means 100%, of course, 80%, 20%. So we have various weights, right, of these stocks in this portfolio. Okay, and we did some calculation and found out the expected returns for each of the portfolio. And this can be done, as you know, using what we taught in lecture 2A, right? When we covered expected returns and how the covariance or correlation impact the portfolio volatility. And therefore, you can calculate this. So we're not going to go through a calculation because that has already been covered or recapped in lecture 2A. All right, so very good. We have expected returns, we have volatility. So now what we do is like, we want to plot a graph. Let's plot the graph of the y-axis, expected returns, and the x-axis, volatility, right? Okay, let's do a graph here. And when we plot this graph, we see that, hey, you know what? We see that the points form this interesting, like, they call it parabola or like a curve, right? A parabolic curve. And this is what we are kind of interested in. So we see this curve thing, right? As we plot. And this y-axis is expected return. X-axis is volatility or standard deviation, right? So it's total risk. Now, so what's happening here? So I want to highlight that this graph is super important because we'll keep on going to the graph for 2 hours of this lecture. And so, you know, if you do have any questions on this graph, do not hesitate to stop me because all the information that we are going to cover in the 2 hours will keep on building on the graph, right? We're going to analyze the graph a lot. So now let's have a look here. We have this curve here, this red box. So I've put this red box here. Can you see this red box are kind of this thing called efficient portfolio, right? Remember, because I'm going to flip back here. So what are efficient portfolios? The highest expected return for given volatility, right? And then we have inefficient portfolios as well. So the red box here gives you the efficient portfolio. And the reason being is, what does this mean? Okay, so for example, I want to take maybe like 22.5% standard deviation, right? So I'm going to draw a line here, something like that. No, it's a bad example. This is not so. Okay, so maybe it's a bit tight, but let's say I take it like this, right? I want to take this amount of risk, which is measured in standard deviation, right? However, can you see that in your portfolio, which one should you choose? Should you choose the point in the red box or out of the red box? In the red box. Perfect. You're right. So in the red box, yes, that's correct. So we should choose here. So instead of here, even though as we plot the graph in the last slide, we can see that there is a portfolio that provides you a return that's here, right? It makes sense because this one is giving you so little return compared to this one, right? This is giving 15%. This is giving you like 6%. So whatever that is below this maximum point here, this part here, are all considered inefficient portfolio. Yeah, okay, so that's the question. Yeah, what is inefficient? So whatever that is below this point is inefficient, right? Because if you want to take on let's say, remember just now I say, if you want to take on this amount of risk, which is given by standard deviation, you might as well take this upper portfolio rather than this portfolio here, right? Because this portfolio is going to give you 6%, this portfolio is giving you 15%. So we can straight away divide the portfolio into inefficient and efficient. Okay, maybe I'll pause here. Any questions regarding how we differentiate inefficient and efficient portfolios? Okay. All right, so basically, what's interesting is that every time you create portfolios, all your portfolios with different weights will all create this kind of pattern. So it's not only this Intel and Intel and Coca-Cola that will give this pattern. All portfolios will give this pattern, and that's why it becomes a modern portfolio theory. It becomes a theory now, right? So yes, the inefficient portfolio is the portfolio when at this point here, at a given risk level, at this risk level, which is measured by standard deviation, the inefficient is the one that's lower. And we never want the inefficient, which is below, which is out of the red box here, right? So basically, once we see this inflection point, so this is going back to a bit of mathematics, when there's an inflection point, meaning a turn in the graph, when there's a turn, whatever that's below the turn here, it's all inefficient portfolios. Whatever that's above is called efficient portfolio here. And of course, it need not only be 80-20, right? It can be 80.5%, it can be here, it can be here. So there are a lot of portfolios. So it's not only how many portfolio? 1, 2, 3, 4, 5, 6. Not only 6 points, right, on the graph, because there is the full range, right? It can be many points here. Okay. So we have covered the 2 points as mentioned, efficient portfolio and inefficient portfolio. Now, what's the efficient frontier? So efficient frontier is a set of efficient portfolio that is northwest portion of the curve. So what does northwest portion mean? So we have our compass here. West. So the northwest portion, can you see the northwest portion? That means northwest is where? Northwest is here. Okay, can you see that? Is this the northwest portion of the curve? Is the northwest? That is the efficient frontier. Okay, so going to your question, what is inefficient, efficient portfolio? Okay, so maybe I did a bit too fast. Maybe let's repeat again, okay? What is efficient and inefficient portfolio? So remember, today's lecture, we are focusing on modern portfolio theory, right? So we're not just talking about any portfolio now. This is a theory, right? So in this theory, inefficient portfolio means something. Efficient portfolio means another thing, right? And so this modern portfolio theory is solely based on this graph. And we are going to talk about this graph for 2 hours. Of course, we're talking about various aspects of the graph, right? Everyone follows that, in case those that didn't catch it. So in this theory, an inefficient portfolio is a portfolio that is here, right? Out of the red box. The reason being is that at a given volatility, for example, it is giving a lower returns. So yes, inefficient portfolio is lower returns, efficient portfolio is higher returns. However, you must take note that it is relative to this graph, this plot that you have drawn here. Okay, so everything on top is an efficient portfolio. Hope I answered that question. What's an efficient and inefficient portfolio? So as you can see here, this is an efficient. So every portfolio on this point here is efficient. Every portfolio on this point here is inefficient, right? And again, I'll stress that there can be infinite number of portfolios, meaning what? So this example is 80% Intel, 20% Coca-Cola. It can be 0.82, 0.18, right? These are all percentage. So it's 82% Intel, 18% Coca-Cola in your portfolio, right? So it can be any number. It can be 0.81, 0.19 as well. So there are infinite number of portfolios that is present on this line. And the efficient frontier is in your northwest portion. The northwest portion is given by this portion here, the frontier. Okay, that's a good question. How do you determine a cutoff point? So the cutoff point is determined by the inflection point. Remember, I mentioned inflection point. So inflection point is the point where the parabola, which is this shape of the curve, it's called parabola, is changing direction, right? So can you see it changed direction at here? It changed direction. It's going up here and then it changed. So this point, the inflection point, is where the inefficient portfolio becomes a efficient portfolio. So in this aspect, do not worry. You will never be asked to plot a graph and determine it, because this theory is really about understanding, and we'll see how they can test you later, right? However, do not worry that they will ask you to plot a graph and like your primary school and all those things. So okay, that's a good question. What if it's a perfect correlation? Okay, so we're going to go now. Let's move on. So I like that question. So this is exactly what is happening here. So we are talking about correlation, right? I'm glad you asked that question, because if you review lecture 2A, you know that correlation plays a big role. So what happens? In a typical case, there is no perfect correlation, right? So a perfect correlation means perfect plus one, right? That's perfect correlation. Negative one is perfect negative correlation, which is what we want. In a portfolio, we want negative one. Now, of course, this will never happen in real life. If it's a perfect correlation, your modern portfolio theory, as you plot the graph, becomes a straight line like this. It's no longer a parabolic curve. Now, if your correlation is negative one, it becomes like a triangle here like that. Reason being why? We'll have some calculation in the next slide, but just think about it, right? If it's a negative one, means that at certain point, both the standard deviation of two of the, because now we're talking about two stocks only, two of the stocks would cancel each other, and so there is no more risk, right? So there'll be a point of no risk. However, you still get some returns, and this is the point that is given by this sharp point here, where volatility becomes zero. However, we have certain returns. All right. Anyone needs me to repeat this point, or we are good? So, of course, in most cases, we don't have a perfect negative correlation. We don't have perfect positive correlation. So that's why all portfolios becomes a parabolic curve like this, where correlation can be negative 0.3 or positive 0.3. Okay, so we need two stocks. So we are going to start with two stocks, but we are going to introduce more and more stocks. We'll see 5 stocks, 10 stocks, and then we'll look at the graph with more and more stocks. So that's why I highlight it's important to understand first the two stocks. And as we add more and more stuff inside, it gets complicated, right? So now we have talked about the efficient portfolio, inefficient portfolio. We have talked about now the correlation, how correlation affects the graph. right? If everyone's comfortable with this, we move on to the next part. This is a bit of calculation showing you what happens. So when you have perfect negative correlation, which is what we want this, right? Perfect negative correlation, because cancel out is the best. Well, we get a point where the standard deviation becomes zero, portfolio standard deviation becomes zero, and this is the point represented by here. Okay. So I'll not go through a calculation because this is covered in lecture 2A as a recap. Now, correlation. Okay, so just want to quickly check. Did you go through lecture 2A? Because in lecture 2A, we actually covered correlation in detail. No, okay. So okay, what I highly recommend is, okay, I'll go through correlation quickly for benefit of at least those who didn't go through. However, I'll recommend to look through lecture 2A after this lecture is done, and then rewatch this lecture. Then you'll understand a lot of things, because lecture 2A is like kind of a mandatory lecture to look before we actually go into lecture 2B, right? Which is what we're covering now. Okay, so as a quick recap, right? Remember, correlation is how the stocks move with each other, right? So as the stocks move in the same direction, they are same direction, meaning what? Like I have, let's say a supermarket stock. I have fair price stock and I have cold storage stock. So both cold storage and fair price stocks would move in the same direction when certain things happen in the market, right? So yeah, correct. You're right, positively correlated. So what are certain things? For example, if inflation goes up, maybe people would buy more grocery, right? Why? It's because they want to reduce their eating out. So they want to buy more groceries, cook themselves. So because people buy more groceries, both stocks are moving upwards. So they're perfectly correlated. Now, however, if we think about things like airline industry, right? SIA versus supermarkets. So as inflation goes up, people buy more groceries, maybe fair price stock will go up. However, because people have lesser discretionary income, they'll travel less, and hence the airline stock, SIA stock will go down, right? So this becomes a negatively correlated. It need not be perfect, but it can be negatively correlated. And therefore, correlations would help to reduce risk, right? It reduces the unsystematic risk, as we mentioned in lecture 2A. Okay. So for those that did not watch it, watch lecture 2A, I highly recommend, first of all, after this lecture, watch lecture 2A again, or not again, but let's watch it the first time, and then watch this lecture again, and then you'll really understand everything. Yeah, okay. Do we put more sector correlation or that's a good question. So now in this module, we actually look at all kinds of correlation. What does this mean? We talk about geographical, we talk about even stocks versus bonds, right? So those that are really in the market or are interested in markets, right? You know that now is the best time to buy bonds, best time to hold stocks, best time to buy bonds, right? So we'll talk about different product, we talk about sectors, domestic versus international. So we'll talk about everything in this module, which is kind of why I think it's a very useful module, and it's nice to go through and understand, right? Even for your own personal investment. Okay, so portfolio selection. So if we invest in more than two, so we have a question, right? Earlier, we only talked about two stocks, but we have more than two assets and we put them in a portfolio, which is actually most of the case, right? We have more than two. What will happen? What we get is this thing called a minimum variance frontier. And what is this? We'll see in the graph, but let's understand what it is first. the set of portfolio that have the minimum volatility given a level of return. Okay. So what does this mean? It means that previously we are only talking about two stocks, right? And when we talk about two stocks, it was just a line like that, right? It was just like a parabolic line. Now, when we have more and more and more and more stocks, it's no longer a line. What happens is that we get a area of this line, right? And what is the minimum variance frontier? The minimum variance frontier is the frontier that is given by this line that I just re-highlighted. And why is this called a minimum variance frontier? It means that it is the least volatility for a given return. So it's the best option that you can have. Okay, let's look at a graph to try to understand this again. Now, we can see here that we have a 10 versus 3 stocks portfolio. Okay, so the 3 stock portfolio is given by dotted line here, the dotted line, right? And a 10 stock portfolio is given by this other solid line, right? And recall, you can have a 20 stocks portfolio, 30 stocks. And what happens is that as you add more and more stocks, the line keep on moving closer and closer towards the triangle. Remember triangle where you get perfect negatively correlated. So let me just flip back here. We get closer and closer to this triangle here, right? And so the more and more stocks you add, we get closer and closer to this. However, in real life, we'll never reach perfectly negatively correlated, right? Meaning we cancel all volatility. That will never happen. But what happens is that we keep on getting closer and closer to this. So you keep on getting like more and more of this. Okay. So the efficient frontier, of course, is the frontier that is as close as possible. For example, if we add 25 stocks, right? We get a frontier like this, right? But never touching the zero, of course. Now, this frontier here is called an efficient frontier, right? Efficient front. Just give me a moment. I have a notification to sign into Zoom again. All right. Okay. So everyone understand this efficient frontier? Yeah. Okay. Good. We are following. Now, so that's one part of efficient frontier. Now, let's think about things now. So we talk about two stocks. We talk about adding more and more stocks. You push the graph closer and closer towards the y-axis. Now, let's think about putting in risk-free assets now. What's risk-free assets? It means like fixed deposit, or you put things like cash in bank. Yes, you get more diversification. Treasury notes, perfect. Yeah, treasury notes. But let's understand a bit of the calculations, how it works. So can you see here that, risk-free assets, of course, we know that the beta of risk-free assets is 0, right? Reason being because there is no risk, of course. So variance and beta, variance, volatility, meaning standard deviation, everything is 0 for risk-free asset. As it mentioned, risk-free. So we have this thing where we know how to calculate expected return of a portfolio, right? As we covered in lecture 2A. is just the weighted average, right? Where W is the weight. W is the weight. So weight of the expected return of the portfolio plus the 1 minus weight, right? So what is the, if you have a portfolio of, let's say, W is 30%, right? 30% of portfolio, and then you put in 70% of risk-free, right? Risk-free RF. Yeah, RF, right? RF. So 70% RF. So 1 minus W is the 70%. And you know, risk-free, what is the, we have a return for risk-free, right? RF. So this expected return calculation. Now, how do we do this, the so-called portfolio standard deviation? Portfolio standard deviation is W square, right? If you recall lecture 2A, we mentioned it, W square times standard deviation of portfolio square, because we are use the variance, plus the, now why is it 0 plus 0? Because our risk-free has 0 standard deviation, right? As we mentioned, volatility is 0. So you plus your 0 volatility and plus 0, because remember, to calculate the ending part of the formula, you must multiply by SD, right? Everyone remember? We're going to multiply by SD. And SD of risk-free is 0. So when you multiply anything by 0, it comes 0. So it comes 0 here. And then at the end, we need to square root it because we are calculating standard deviation, right? And so what we get is this. What's interesting now? Do you notice something? And anyone can notice what's happening here? And anyone knows or not so sure what's happening here when we added risk-free? Oh, that's great. You are totally right. Expected standard deviation equals the weight of the actual standard deviation. Okay, so I'll go and explain this again. What does this mean so everyone understands? The new standard deviation or expected standard deviation, which is the right way to call it, so new standard deviation becomes just a portion or the weight of the initial standard deviation, because you multiply by weight. And remember, W is 30%. So in this case, it has reduced the risk, the total risk by 70%, because it's just the weight of actual. And this is why, you know, when you create your portfolio, you must include risk-free assets, right? You reduce your standard deviation. However, do you notice something? Your expected returns is not lower, right? You're still getting your expected returns on your portfolio plus your returns on the risk-free asset, right? As given by here. However, there is a bit of weighing that is being reduced by. But what's important to take note is that the volatility becomes only a fraction of the volatility of the risk-free asset. Okay, so what am I doing now? So I hope everyone understand that. Do we need me to repeat this portion here before we go on? Okay, so in case some of you are a bit rusty on how to calculate standard deviation of portfolio, do not worry. Refer back to lecture 2A recording. I have went into a lot of details on how we calculate standard deviation of portfolios in general first. And then now, of course, we are building onto the knowledge of what we covered there. And lecture 2A, of course, it's more on your year 1 topic, which is covered in 203. On how we calculate standard deviations of portfolio. Okay, so given the two things that we have calculated, right? So this is what we've done earlier. This is what we have done earlier, right? We have already done that. Now, what do I do? What if I make W equals to the thing, right? So I make W equals to SD, the apostrophe one, that thing means that the new SD, right? The SD here with the risk-free asset inside. So what if I make W the subject and equals to SD of the new portfolio divided by SD of the original portfolio? So if I substitute 2 into 1, so I substitute this inside to W. So I want to remove the W here. So I put it in like this. Okay. And then I do a bit of shift, right? What do I shift? I shift this thing inside here and move this SD out here. I'll just erase this a bit so you can see. So I eventually get this formula here. Now, also kind of like tapping onto your, because this is a year 3 kind of or level 3 kind of module, we are going to tap onto your year 2, year 1 module. We call this thing called a Sharpe ratio. And what is a Sharpe ratio? A Sharpe ratio gives you the, as a quick recap, a risk and reward ratio, right? How much risk you take and what's your reward that you get, right? Your Sharpe ratio. So I've just shifted and give you this formulation, RF plus this thing called Sharpe ratio times your SD of the new portfolio. Anyone can kind of recall what kind of formula does this look like? This formulation, what does it look like? What kind of equation does this look like? Anyone knows what equation does it? So thank you. Thanks for answering that again. You are right. Y equals mx plus c. Perfect. And this is the equation of a straight line. Everyone knows, right? Y equals mx plus c. What is your m? Your m is your Sharpe ratio. Your x is your let's see, your x is your x-axis is your standard deviation, which is given by volatility. Of course, your y is your expected returns, right? So so what's important is your gradient of this equation that we have formulated is given by a Sharpe ratio. Okay, just hold on to that thought. Let's look at what does this really mean. So it's a straight line, right? So investment opportunity that produce a risk-free asset combined with a portfolio becomes a straight line, right? Remember earlier we were talking about the parabolic curve, we are talking about this kind of curve. However, once you add risk-free asset inside a portfolio of 10 stocks, 20 stocks, it becomes a straight line. So this is very interesting. That's why it's a kind of a theory, right? It becomes a straight line. And this straight line is defined, or what's important to you in this straight line is the Sharpe ratio, because it gives you the reward and volatility, or risk and reward, usually quite risk and reward ratio of the portfolio. So, hold on. Let's see what's happening here. I need this graph. Just give me a moment. Okay. Let me just reopen the file. Okay, now it's working again. So what does this mean? It means something. Remember I said initially the portfolio is a parabolic curve, but once we add risk-free asset, what we produce is y equal mx plus c, which is a straight line. And what does this straight line mean? And remember we say that the gradient of the straight line, gradient meaning whether it's this steep or this steep, is given by a Sharpe ratio. So if we go and plot the straight line, the straight line means that a portfolio plus risk-free asset add together. When we plot this straight line, we can plot various gradients, right? Gradient given by the Sharpe ratio. So it can be gradient like this, like this, like this, infinite number. However, there will be one line that touches or is tangent to your efficient portfolio. Remember, we already talked about where the efficient portfolio or efficient portfolio is. It is on the northwest side. So after the part where there is a so this is the efficient portfolio here. This is inefficient here. All these are inefficient here. So the efficient is on the northwest side. So when this line touches the efficient frontier, this becomes your tangent portfolio, right? Tangent, because it's tangent on your efficient frontier. Does anyone need me to repeat this? What does this mean again? Okay, what does it mean in simple term? Okay, in simple term, it means that, okay, okay, let's just erase this first so it's easy to look at it again. So in simple term, what does this mean? It means that in simple term, we started with two stocks that looks like this, right? A parabolic. When we add more and more stocks, your parabola keep on moving closer and closer, right? That's what we look at. Now, those are just portfolios of stocks. However, when we add risk-free assets inside, what happened? Instead of this kind of shape, what do we get? We get a line, right? We get a line instead. So now, and we have calculated earlier that we need to add risk-free asset because it reduces volatility in our portfolio. So as a portfolio manager, you must recommend to your client to have stocks, a portfolio of stocks plus a risk-free asset. And what happens is that when it becomes a line like this, there are so many points on this line, right? Should we take a portfolio on this line, this line, this line? Which part of the line should we take? Now, the theory says that it must be the line that is touching the efficient frontier, right? The efficient frontier given by what we have plotted on this thing here, right? The parabola. When the line touches the parabola, it's called a tangent portfolio. And this portfolio is the best. Is the most best in the sense of the least volatility and the most least volatility for a given return. Then in simple terms, why so in simple terms, right? Let me just zoom in a little here. Remember, when we determine the efficient portfolio, right? The efficient portfolio is all the portfolios here. The question that we have is, should I have a portfolio here? Should I have a portfolio here? Where should I have a portfolio? You don't know, right? Because there can be infinite, remember I said there can be infinite number of portfolios in your efficient portfolios. So this, by adding the risk-free asset, you kind of already determine where your portfolio where's the best portion of portfolio should be. And the best part is when it is here, right? Like this. And I want to highlight one more thing that remember your line can have different gradients, right? So your line can have different gradients given by your Sharpe ratio. And we should choose a Sharpe ratio that gives a gradient that touches the efficient frontier. Okay, I see a question. Why did it become a line? Remember we did this? We calculated this. We did a calculation here to show what happens when we add risk-free asset. And then we just did some manipulation, and we show that in the end, our equation becomes this. And your friend was saying that this looks like y equals mx plus c, which is true. And because it looks like y equals mx plus c, y equals mx plus c is a straight line. It's a straight line. That's why it becomes a line. Oh, okay. So now that's a good question. So how do you reverse engineer? So usually okay, so this is more on like practical side of things, right? Like what happens in the industry. So what happens is this. People plot this, right? However, most of the time, your client, because remember, we are still thinking about a portfolio manager. You have a client, right? Your client usually have certain expectation, right? So for example, this efficient portfolio can give you this amount of return. However, maybe your client want 22.5% return here, right? Now, what happens? Because we know that this is not your tangent portfolio, it's in order to get this 22.5, is not the line and the curve does not touch, right? It means that what? It means your normal portfolio cannot give you this kind of return, right? Because remember, your any portfolio only falls on the efficient frontier, right? Efficient frontier. And if something out of efficient frontier, that's not a portfolio you can get. So what it works in the industry is this. We plot this thing, then we speak to our client. Okay, the client say, I want 22.5% return. Or let's make it a bit more exaggerated, right? Let's say your client want 25% return here, right? Which is like here. And so you know that it obviously is not in your portfolio frontier, efficient frontier. You cannot get this amount of return in your portfolio. And that's where we use this graph to suggest how the client can get this return. And this is the interesting part, okay? And it's the next part of our discussion. So now the question is, for clarity, the question is, the client say I want 25% return. However, based on the graph that we have drawn, we know that it is not part of our efficient frontier. And again, I want to highlight what is efficient frontier. Efficient frontier is your parabola, right? And only your portfolio can only give you returns on this parabolic shape, right? As we calculated by the 2 stocks, and you have 5 stocks and 10 stocks, etc. We already have showed that, right? So your portfolio can only give you returns on the parabola. But what if your client say, I want a return here, like here, this X here, right? So if we have drawn a risk-free line, which is quite bad, we've drawn it here. So how do we achieve that? And that's where we need to adjust the weight, and we need to see what can we do. Okay, so what does the optimal, so we'll touch on that, just hold on to that thought. So what is an optimal portfolio? Optimal portfolio is one that must include risk-free asset, because we have already proven on the graph that when you have add risk-free asset becomes a line, and the line that touches the parabola is the tangent portfolio, which is what can be achieved, what is the best. And you want ones with a higher Sharpe ratio, as we have seen here, right? We have seen here, Sharpe ratio determines the gradient, and compare the Sharpe ratio. So maybe I did not highlight this part of Sharpe ratio. So compare two Sharpe ratios, right? let's see, let's compare two Sharpe ratios here. So we have one Sharpe ratio given by this, which is steeper, compared to this Sharpe ratio is more gentle in terms of gradient. Can you see that for a given volatility at 14% standard deviation, of course, the steeper your line, the higher returns, right? So we want the optimal portfolio is one with the steepest Sharpe ratio. And this is given by the line that is tangent to the efficient frontier. And this point that is tangent is called the tangent portfolio here. So there's quite a bit of terminologies that, because it's a theory, so it's quite a lot of terminologies that you need to be familiar with. So tangent portfolio, which is that dot that I draw earlier, is the one with the highest Sharpe ratio of any risky portfolio. It provides the best risk and return trade-off, right? And remember, this tangent portfolio is one portfolio here. Is the portfolio given by this dot here, where both lines touch. So in one portfolio. So this is just a bit more of explanation. Okay, so I think you're still struggling a little with the understanding of correlation. Recall what we have done here, where we did a mathematical calculation of why adding risk-free asset reduces the volatility. So, do not worry if you are not able to catch this. This lecture is recorded. I really encourage you to watch lecture 2A and rewatch this, right? And of course, if you have any questions, drop me an email. We can follow up the discussion to try to understand where your doubts are, right? But we have showed that in short, what we have showed that by adding risk-free asset, it reduces the total risk because it reduces standard deviation, right? Because risk-free assets have zero volatility or zero standard deviation. Okay, so what does this mean? All efficient portfolios are a combination of risk-free asset and a tangent portfolio. So we have already showed, and that's a great question, right? Why must we add risk-free asset? Because we have kind of already proven to you that, hey, you know what? When we did the calculation, when we add the risk-free asset, it reduces the volatility, but it maintains the expected returns, right? So it kind of like, we use mathematics to prove to you. So there's no we can't really argue that, no, it's not true. I do not believe in it, but we have tried to show it in numbers as well, right? So this is the efficient frontier. The efficient frontier essentially becomes a straight line. What does this mean? It means that this, right? Initially, recall again, this is a repeat. Initially, we have a parabolic curve like this, right? And then what happens is we added risk-free assets, and then we showed that it equals to y equals mx plus c, and y equals mx plus c is a straight line. Let me try to draw it nicely like this. Oh, very nice, straight line. So we show that we are able to plot a straight line by adding risk-free assets, and the gradient of the line is the one that is touching the frontier that is the best, right? So the steepest and touching the frontier, because the frontier is where your portfolio returns can be. So we found out that, hey, you know what? This point here is your tangent portfolio. And what does this mean? It means that once we determine the tangent portfolio here, we are actually uninterested in this curve anymore. We're not interested in the curve, right? So the efficient frontier now essentially becomes this line, right? What we're interested in is the line, no longer the curve. So the optimal portfolio is actually not dependent on the investor's risk aversion, but it should be determined by the tangent portfolio. So basically, so what is he trying to say? Okay, in simple terms, what is he trying to say? It means that if you are going to create a portfolio, you shouldn't be afraid about, oh, what's the risk of the asset? What's yes, I mean, risk returns are important to consider, but it shouldn't affect your decision making. What you should do is you plot this graph, you find your efficient frontier, you find where your straight line is by adding risk-free assets, and it automatically tells you this is the portfolio you should buy. And then you just buy it as a portfolio manager, right? You recommend it to your clients. And so it really in the industry, what happens is that you have to do all this. Of course, you don't need to explain to your client to make them understand this whole theory, these 3 hours lecture that we are doing. No, you don't have to do that. Usually your client is just interested. Like, how do you actually get this number? Why do you say? So at the end of the day, what is this trying to do? You are trying to justify your recommendation to your client, right? Your client asks you, why do you say I should invest 70% in risk-free asset? Like your friend say, right? Like a friend of yours say, oh, why risk-free asset? Like I can get more returns by just investing in stocks. But why you ask me to invest in risk-free assets? And this, when your client asks you this is where you need to explain your this modern portfolio theory. Of course, you don't need to make them understand, but you try to show them the numbers, right? To prove to them that you did not just pluck out this idea from plain air, right? Yeah. So portfolio frontier is, remember what we talked about, the frontier. So the frontier is basically, can you see here? Let me just erase all this. We mentioned efficient frontier. So the frontier basically, what's the meaning of frontier? Frontier means the most extreme end, right? So we see that there are stocks everywhere, here. The frontier is just simply the line that is the most out. The line that is the most, the front, like it's called frontier, so it's the most front. That's frontier. So the tangent portfolio, remember what's a tangent portfolio? The tangent portfolio is the portfolio given by this dot here that touches, when the line touches the curve, this is called tangent portfolio, equals to a market portfolio. It means the market portfolio. So at the end of the day, when you recommend to your investor, what you need to recommend is how much market portfolio you want and how much risk-free asset you want, right? Because the amount of risk-free asset would shift the line that we talk about. Okay. Okay, so you know what? Let's take a break here before we dive even deeper into this modern portfolio theory. Okay, let's um, take maybe a 7 minutes break. So I know that there are quite a lot of questions. Maybe I have doubts about this modern portfolio theory. It takes a while to understand. So do not worry if you have questions. However, what I really highly recommend is, especially if you have missed watching lecture 2A, I highly recommend watch that first, then we watch this lecture on modern portfolio theory, because whatever we talk about is kind of actually building on to what's covered in lecture 2A. And lecture 2A is actually a recap of what you have probably covered in year 1, year 2. So this modern portfolio theory builds on to the portfolio theory that you have covered in your 203, if I'm not wrong. So do not worry if you have questions. After watching that, you can always drop me an email, right? But let's take a 7 minutes break. We'll come back at 014, right, 15. Let's come back at 15, 8:15. And if you do have any questions, put them in the group chat and we'll cover that. All right, welcome back. I do see a question. So which frontier portfolio is most profitable? That will be when the curve touches the line, right? Or the line touches the curve. So that's your tangent portfolio. That will be the best, right? The best in terms of risk and rewards. As we talk about, remember the Sharpe ratio? When the Sharpe ratio is the highest, it affects the gradient, and therefore um, the portfolio where the line touches the curve is the best. I want to highlight at that question is that recall when you think about portfolio, do not only think about profitability, always think about the risk as well, right? Because we always have, wherever we are a portfolio manager, you need to assess the risk before you assess the expected returns or profitability. So talk about risk first, then think about the profitability. Okay, because that's why we create portfolio, right? Portfolio basically helps to reduce your unsystematic risk. All right. So now let's try to move on and move a bit deeper into this portfolio theory, right? So I hope that small break was good enough to kind of refresh yourself a little. Let's go deeper into this portfolio theory now. So we have already talked about the line, we talked about the curve. Now let's talk about structuring your portfolio and how does it change on that diagram, on your line or the curve. So what's happening here? We go through explanation first, and then we jump to the graph to kind of see how is it being played out there. So if the tangent portfolio, remember tangent portfolio is just one portfolio, just one, the dot where the line touches the curve, that tangent portfolio expected return is below the return objective and margin of your client. Okay, objective of client and margins, i.e. borrowing. So whenever we do margins that are considered their borrowings as not allowed, the tangent portfolio is not optimal for your investor. Of course, right? What does this mean? It means that, okay, I'm just going to flip to this. So imagine your portfolio, not imagine, but your tangent portfolio is here where the line touches the curve. Remember, that's the best portfolio. However, at this tangent portfolio is here, right? The expected return, let's say, is 10% here. But let's say your client, he wants 15%. He wants here, right? Your client wants here. So what should you do? So let's go back to the explanation. So if the expected return of tangent portfolio exceeds the return objective, it may be optimal to hold the tangency in combination with risk-free asset. Now, the thing is, so this is just explanation of the line, the risk-free asset is not so important. Now, the important thing is these 2 points here. So I'll try to explain to you. You can read through the details, but I'm trying to explain to you what it means in like simpler terms, right? So I'm just going to flip to the graph to explain to you. However, the explanation, if you want to refer to, is here, right? It's given by these 2 things here. So what happens now? If your client wants 15%, however, your tangent portfolio only give you 10% as seen here, right? Your tangent portfolio only give 10%, but your client wants 15%. What does this mean? It means that you have to move along the straight line. Can you see? You need to move. This is very bad. You need to move along this straight line here. You need to move up the straight line. Can you see? And how do you move along the straight line? This is kind of being explained here. This and this, minus 40% and 140% of M. So what is it trying to mean? So try to explain to you in simple terms. It means you borrow money, right? You borrow some money from the bank and use that money you borrow to invest in more risky assets. And therefore, you are able to move up the straight line. So you are no longer in the efficient frontier, but you're moving up so that you can get this return here, which is out of the efficient frontier. However, it will give you the 15% that you require. Now, can you see some, did you notice something? Remember the comment that we made earlier that once we include risk-free assets, we're actually no longer interested in the efficient frontier. Our focus is purely on the line now, because if we want more returns, we are just moving up the line, right? And how do we move up the line? We borrow money, from the bank. That's why it's a negative 40% risk-free. And then use the money you borrow, invest in more risky assets that is out of our portfolio, right? So that's why we're moving along the line now. Is it clear for everybody that on this point? Oh, okay. So R is risk-free. M is the a stock, the risky stock that you want to invest in. So you have a negative R. Negative R means you're borrowing money, negative percentage. And then you have M, which is the portfolio or the stock that you're going to reinvest it in. So that's why it's 140% of M. That's why we can achieve a return that is not part of your efficient frontier. Which stock to so you don't borrow, you don't buy a stock to borrow money. So borrow money means you go to the bank and borrow money. But remember, when you go to the bank and borrow money, they charge you the risk-free rate. Risk-free rate. From a bank's perspective, the risk-free rate. That's the R. So you borrow money. That's why it's a negative R, negative 40% R. Okay, so now this is if your client wants 15%. However, if your client wants 5% return, remember in lecture 1, we say that if your client wants 5% and you give your client 10%, basically you will be fired as a portfolio manager. Why? Because you're taking more risk than your client wants. So something that I want to really drill in, right, is that in portfolio management, you really need to meet your client's needs. And getting more profitability, more returns is not a good thing because you're taking more risk. So now, if your client wants 5% only, means what? This you need to move. Okay, let's use a different color. You need to move down the line, right? Because now we are just focusing on the line already. We're no longer interested in the frontier. So how do we move down the line? It means that we purchase more risk-free assets and then reduce our percentage of M, which is like the portfolio that we want to invest in. So we're moving down the line. So it's no longer, remember this, the tangent port. You are no longer at the tangent portfolio M, you are moving down the line, which is not so good. I mean, not so good in terms of return, less return. But if that's what your client wants, you have to give this to your client at 5%. So you move down the line by purchasing more risk-free asset and reducing your exposure to the portfolio. So at this point, again, there is another terminology that I want to highlight. What is this CML? So CML is called capital market line. The capital market line is this special line that touches the efficient frontier. Okay, I repeat again. CML is called capital market line, and this is only one line. It is the line that touches the efficient frontier. Now, you have unlimited number of CAL. What CAL? CAL is the capital allocation line. So capital allocation line is any line. Okay, capital allocation line is any line. uh, what happen? What if the bank don't borrow? So if the bank do not want to lend your client money in order to move up the CML line, then you have to advise your client to say or you have to explore other options like why is the bank not wanting to lend money to your client? Maybe is there some credit risk issues? And then you have to discuss this with your client. Other institutes, besides bank, no. Okay, so I guess in most cases, no, there is no other institutions if your client is an individual. However, remember we in last lecture we talked about client being things like charities. Your client can be insurance companies. So if your client is a non-individual, there are a lot of other way you can borrow money. For example, venture capitalists, if you know VC. So venture capitalists basically or angel investors, they invest money or they so-called um, lend the money to your client to do some other things, right? And so it could be this case as well. So there are other institutions. So it can be like venture capitalists, angel investors, and most of the time their money is not like free, right? It's kind of like a loan as well. Okay, so I hope everyone understand the movement on the line, right? Okay, now let's think about this. So I really like the question that you asked. Are there other institutions that can borrow money? Because that's a good question. Why? Remember that borrowing money is not the only way to take leverage. So this is a bit of a finance term. I hope everyone knows. So taking leverage, what does anyone know what does taking leverage means? Any yeah, okay, yeah. Okay, so maybe you are a bit of a trader as well, so you know that. You're right. Using $1 to gain $10. And specifically, it is taking a loan. Like I put loan in inverted commas because it's not really going to bank and take a loan, but you're taking an underlying loan. So a loan that is implied, I would say implied loan. So not explicit loan. Explicit loan meaning that you take the money from the bank to buy things, but it's an implied loan, right? So that is taking leverage. So why I want to cover this point is borrowing money is not the only way to increase your debt, right? You can take leverage by taking a implied loan to increase your return, and that is actually indirect way of borrowing money. Yeah, that's right. Okay, so why I want to talk about this is because now we're going to cover this thing called short sale. So let's think about long position first. A long position is your classic position. So I go to the market, I buy a stock. I'm taking a long position, right? So just for fun, if anyone is following the stock market now, we know that AI stocks are going crazy, right? Facebook just recorded 25% year over year stock returns, right? So those people that bought Facebook last year will be very happy now because they are recording very good returns. So that's a long position, right? So if I have bought Facebook stocks last year, I have taken a long position and I hope I held it to now. So that's a long position. Okay, what's a short position? A short position is a negative investment in a security. So you sell, what does it mean? You sell a stock that you do not own, and then you buy a stock back in the future. So, question to all of y'all: when would investors sell a stock that they do not own or short sell a stock? In what situation would they do this thing? And it is a kind of taking leverage as well. Yeah, that's right. Yeah, perfect. when they expect the stock to drop. That's right. So it's exactly this. It's a negative position on your portfolio weight. And remember when there's negative position, okay, so remember all these are linked to modern portfolio theory. Yeah. So when there's negative position, you notice what? When you take a negative position, isn't it the same thing as borrowing money? That's why I say it's an implied loan. When you take a short position, it's implied loan because you're taking a negative position as well, right? And remember, we mentioned that this negative 40R is borrowing money from the bank. So in technicality, taking a negative position is borrowing money. You're leveraging up. Okay. And of course, you expect the stock to go down. Uh, and however, I want to highlight that short selling is also advantageous if the price of the asset rise. So this is the part that I want to highlight to you. That is not only when the stock price go down. Yes, the stock price can go up. However, if you can invest the proceeds, because you're basically taking a negative position, it's like taking a loan, right? Implied loan. If you can invest the proceeds of this net short sell into a asset that has higher return than your expected asset price that you take a short position on, you actually can get a return, a profit as well, right? So you basically take the money that you short sell, you put this money into another stock that gives you even higher returns, so that when you close your short position means that you return the money to the to the stock that you actually sell that you don't have. So you actually buy back that stock and you return that stock to the person. If that other stock that you bought, that you invested in, grew more, you can actually get a positive return. So when we allow for short sales, portfolio return and volatility can be higher than the expected volatility of the constituents. So this is an important concept because we want to plot this on the graph. So we are going, remember, we are still talking about portfolio theory. So we'll go back to the graph and see how do we position our short sell on the graph as well. And in summary, it kind of actually says that the curve basically extends beyond the individual asset. So we'll see this in the graph in a bit. I think we have a question here, hedging mechanism to reduce risk. So short sell, yes, it can be a hedging mechanism. That's a very interesting concept. And I think we are going to cover this in lecture 4 on risk management. So if you enjoy, I mean, if you are so far you're enjoying this course, I think you enjoy that part because we're going to talk about synthetic hedges, right? We are going to structured products, synthetic products to reduce your risk. And one of the way to do it is to short sell a certain product and to do a long position on another product. So if you are interested, if you have been interested in this, I think you will be interested in lecture 4, where we will do, I would say I would like to go in more detail in that structured product kind of category because it's very interesting. However, for the purpose of this course, we will cover, I think, 5 or 6 products only, and we focus on risk management and hedging. Yeah, marry a put. Yeah. So you can do a put, you can do various things called straddle, we do a butterfly, those that, yeah, we will cover some of those. They are very interesting. Okay, so now recall before we went on to that small little discussion on hedging, reducing risk, recall that when we do a short sell position, your curve extends beyond the individual asset. And what does this mean? Can you see that? Remember, we'll go back to the curve again, right? So whenever you do a short sell, even though, can you see here, this dotted line, we have a negative 0.2. What does this mean? It means we are shorting 0.2 is Coca-Cola, and we are buying more Intel, right? So you get 1.2. That's why your weight become negative. And in this case, we are shorting 0.5 Coca-Cola and buying 1.5 Intel. And of course, in this sense as well, it's the reverse. We do have a question here to really kind of make you understand what does short selling mean. And let's read this question. Suppose you have 20K cash to invest. You decide to short sell. I'm sorry. You decide to short sell 10K worth of Coca-Cola. Remember, when you short sell, you do not have the stock. You're just short selling it. And invest the proceeds of your short sell plus 20K in Intel. At the end of the year, decide to liquidate your portfolio. You have, if your two stocks have the following realized return, so what is the return on your portfolio? So this is a very simple question on those two stocks. Question can come out of 3-4 stocks and they are the same idea, right? So you are given the initial price, this is ending price, and this is the return. So what happens? So if you short sell the Coca-Cola stocks, so when you short sell Coca-Cola stocks, what's your price of Coca-Cola? Coca-Cola at the start is $40. So how many stocks are you going to short sell? You're going to short 250 stocks, right? Because you want to short 10K. So you're shorting 250 Coca-Cola stocks. Now, with the 10K that you get after shorting 250 Coca-Cola stocks, you buy Intel stocks. So you're buying 30K of Intel stocks. And what's the initial price of Intel stocks? Let's have a look. Initial price of Intel stocks is $25. So you buy 1,200 Intel stocks. Now, at the end of the year, we know that Intel stock became 3150. So 1,200 times 3150 gives you this, right? So this is the proceeds you get. However, you have to close your short position, right? You have to pay back your short position of Coca-Cola stocks. And of course, your Coca-Cola stocks also increase in value. Remember? So this goes back to the point I say that you need not, your price of the stock need not be dropping, but if you invest in something that grows more, you can actually get the profit as well. So yes, your Coca-Cola stocks grow $2.40 from $40. So this is the cost of, you need to pay back 10K 600. All right. So you pay back, you get this amount. Now you have an out-of-pocket expense, right? Because you initially put in 20K. So what's your returns? Your returns is 7,200 divided by 20K. So your return is actually quite high, 36%. You get a 36% return, which is higher than the return of either stocks. Okay, let's look at what this means. Can you see that it's higher than just buying Intel, it's higher than just buying Coca-Cola because you have taken a short position. And so at this point, I want to highlight to everyone that by taking a short position, remember I say we are taking an implied loan. And whenever we take loan, we're actually increasing the risk for our clients. So short positions should only be taken if you clarify with your client that they're okay to take on more risk. Remember, the more risk you take, the more returns you get. So in the short position, you are taking more risk by taking an implied loan, but you get more return, right? And the risk of this loan is that if you have no liquidity to pay back this short position, that's where you become bankrupt. So what happens in the market? So there's a small little sidetrack. What happens in the market? Why a lot of people become bankrupt or file for bankruptcy when taking a short position is this: when the stock price of their short position, in this case Coca-Cola stocks, increase a lot faster than the stock that invest in this case Intel, right? So imagine you take a short position of Coca-Cola and you buy Intel. However, both stocks increase, fine, but the increase in Coca-Cola is more than your Intel. And so usually a short position is held for less than a year, maybe 6 months. You have to pay back your short position. And if you are unable to fork out more money to pay off the short position of Coca-Cola because it has rise more, because you have to take money from outside, right, to pay back your short position, you become bankrupt. That's why taking a short position is really risky. Increase the risk, however, increase the rewards as well. So moving on to the next problem. Again, we're talking about Intel and Coca-Cola. So Intel has a volatility of 50%, Coca-Cola has a volatility of 25%. Stocks are uncorrelated. Okay, what is the volatility of the portfolio that short 100K of Coca-Cola and 30 and long 30K of Intel? So what does this mean? So I put a small calculation here. So how do you calculate the weight of the portfolio now? So if you are, let's do a Coca-Cola first, because we are shorting 10K. So we take negative 10 divided by 20. So we get this. Now, we know that we are going to use the proceeds, not use the, is it use the, yeah, we're going to long 30K, right, of Intel, but we only have 20K. So this is we have a 1.5, right? Important is that when you 1.5 plus negative 0.5 equals to 1. So 100%. Of course, your portfolio must be 100%. It cannot be more than 100%, right? Portfolio is maximum 100%. So now using the portfolio standard deviation formula, again, this is covered in your year 1, or again, a recap in lecture 2A. We can actually find out that the standard deviation exceeds, you get 75% standard deviation. Can you see that? What's the standard deviation of individual stocks? 50% and 25%. And remember, SD equals to total risk. So actually, you're increasing your total risk by quite a bit. You're increasing it to 76%. So it makes sense, right? Higher risk, higher return by doing a short position. Okay. So far, any questions on portfolio theory now? Because we are going to move on a little deeper in portfolio theory, but it's a small side track of portfolio theory. May I pause here for a while? Any, maybe not questions, but if you have some kind of clarifications that you might have. Okay, I think we are good. No questions. Okay, so which question do you need to repeat? First one. Okay, so for the benefit of everybody, let's redo this one, right? This question on short selling position. So basically the question asks you, sorry. So basically the question say you want to short 100K of Coca-Cola and use the money to invest in Intel, right? And then you have 20K of cash that you want to invest in Intel. So in aggregate, you're going to invest 30K in Intel. You're going to short 10K in Coca-Cola, right? To get the additional 10K because you only have 20K cash. So we do know that there are two different price of Coca-Cola and Intel given by 25. For Intel, Coca-Cola is 40 at the initial price, and we know the ending price of Intel and Coca-Cola. So when we do a short position, basically what we do, we first calculate if we want to short 10K, how many Coca-Cola stocks must we short? So we found that we need to short 250 Coca-Cola. Now, by shorting 250 Coca-Cola, we get 10K cash, and we add this to our 20K. So we have 30K in total to buy Intel. And so how many Intel stocks can we buy? We can buy 1,200 Intel stocks. Now, at the end of our holding period, we want to close our short position, right? So we sell off our Intel at the given price in the market at 31.50. Now, to close off our short position in Coca-Cola, we need to pay back the 250 Coca-Cola stocks that we have short. So we take 250 times the prevailing price at the end of our holding period, which is 42.40. We need to pay back 10K 600. And so your final proceeds after paying back your short position of Coca-Cola is 27,200. And we know that there is an initial out of pocket of 20K. So what is our profit actually? Our profit that we get is 7,200 divided by initial investment because we only fork out 20K at the start. So we have a 36% return. Now, moving on to utility function. So we have covered the modern portfolio theory. Now we're going almost the last step, even deeper into the curve. So this thing called utility function. So what this utility function means? Okay, let's try to understand it. So we have talked about the portfolio. We talk about the putting a short position. We talk about the line putting risk-free asset. But have we considered from an investor perspective, your client perspective, what is his risk aversion? What is he willing to take? What kind of risk is he willing to take? So now these utility functions tackle this component. So yes, we have talked about the portfolio, one portion, but now let's go back to a client. So let's think about the client. What is his utility? Utility means like what is his risk aversion level? How much risk will he like to take? So that's what we're going to talk about in this last portion of modern portfolio theory. And so the idea being that if you're a portfolio manager, you need to recommend a portfolio that meets the investor's expected utility. So how much is he willing to take in terms of risk? Okay, so the utility function is given by this formula here, and there are various components. So I will not talk about how the formula is being derived because it's usually is being done also by a graphing method, and that's how they form this this formula here. So what does this formula means? The expected utility of an investor given by UM is equal to the expected return based on the allocation of the portfolio, right? So this expected return. And then there is a deduction here. So these are deductions. So this deduction happens based on the investor's risk aversion. Risk aversion means you don't want risk, you're afraid of risk aversion. And based on the variance of the return of the portfolio, meaning the variance, right? That means square of standard deviation. So if an investor is indifferent to risk, that means he don't mind taking more risk, less risk, he doesn't care. It means it's risk neutral and RA is zero, right? Risk aversion is zero. So the higher the RA, the more risk adverse the person is. If he don't care about risk at all, he's zero. The utility is adjusted. So it's just explaining that it's adjusted based on the risk aversion. And this factor here is where you penalize or reduce the return on the portfolio, right? Because imagine this. What's this equation trying to say in simple terms? It says that, okay, the portfolio has 10% returns, right? But however, remember your investor is very risk averse. He's afraid of risk. Maybe he only wants 5% return. So there is a reduction in his expected return based on this factor here given by the reduction factor, the risk penalization. So initial portfolio 10%, he's very risk averse. It reduces the utility of the investor, and therefore the expected return becomes 5%, right? And so this is given by UM, expected utility. So we have a bit of calculations first before we go to look at the graph. So we are given by this, okay, so we have asset allocation A, B, C, we have expected return, standard deviation, we notice that for Robert, this guy Robert, he has a risk aversion factor of 5. Okay, so we just plug in the various numbers into the formula. We calculate what is his utility, right, as given here, and the one with the highest is the best, right? The highest risk adjusted expected returns. So that's the so based on this, we should choose allocation C, which gives the highest utility. Now, let's look at the graph. So we have talked about the efficient frontier given by this parabola. We have talked about the straight line or the CML line, capital market line, which is just that line that's tangent to the efficient frontier. Now, the utility function is given by this thing called an indifference curve. So this curve, right, is keep on curving downwards. And just now, okay, I'm going to flip back. This thing that we calculated here, if you plot it on a curve, it gives you different curves like this. It gives you different curves. And the question now is, which curve or which indifference curve based on the investor's utility function should we take? And the question is, the answer, sorry, is the indifference curve or the indifference curve of the utility function that is tangent to the capital market line. So that means this is what we should recommend to our client. This basically when the indifference curve tangent or touches the capital market line, this is the one. So quick question here to see whether everyone's following. How do we get this capital market, the allocation at this point here, this X here? What do we need to do to get this portion here? What do we need to do to our portfolio? Anyone knows? What do we need to do to our portfolio to get this point given by the indifference curve touching the capital market line? Okay, not quite. Anyone like to try? Ask the investor, not quite. So we talk about specific strategy. So no, so these are the kind of questions you might expect, right? Like you will never be expected to plot this kind of curve and everything, but this is kind of like more conceptual questions that you kind of expect like to be asked, right? So maybe yeah, I'll repeat again. So so you need to okay, so in case a question ever comes out like this, they plot for you the curve, they ask you what must you do to ensure that your indifference curve based on your utility function of your client matches your portfolio that you prepared. So what must you do to your portfolio? So recall, what must we do? Recall that your market portfolio is here, right? Given by the X here. Now, how do we move up to this point given where the indifference curve touches the capital market line? What must we do? We need to borrow money. That's right. We need to borrow money. Wherever we talked about it for quite a while earlier, we borrow money at risk-free rate to purchase more of the portfolio so that we can move up the capital market line. So this is something they need to explain in case they ever ask you a question like this, right? These are kind of more conceptual questions that can be tested. They'll never ask you to plot. But yes, we need to borrow money, increase the risk-free, so we have a negative. So basically we have a negative, remember the negative R, and then we have the 140M, right? So we borrow money and we buy more of the M to move up the capital market line because our investor wants a return more than our tangent portfolio. And remember, our tangent portfolio is a portfolio that is provided by our efficient frontier that can be provided by efficient frontier. So we need to move up the capital market line in this case. So another question is, what if our indifference curve never touches the capital market line? So which stock should we buy more? So based on, so remember we are doing portfolio management. So we're not buying individual stocks now. So I hope you can appreciate that we need to buy more of the portfolio. So not about buying individual stocks, but more portfolio, right? So going back to my question is, I asked, what if your indifference curve never touches the capital market line? And that's where we need to either rebuild our portfolio, change our portfolio altogether, so that our portfolio can touch the indifference curve, because our indifference curve is what our client is willing to take, right? Remember, we calculated the difference utility function. And so if it doesn't match, that's where we need to go back to our IPS. We need to remember when we talk about risk and return, there's the metrics that we talk about in lecture 1. We need to try to identify, okay, talk to your client, is his expectation too high? But actually maybe his willingness to take risk is high, but his risk ability is low, right? Remember these metrics, willingness and ability. If your willingness is high, fine, your utility function might be very high. However, your ability is low, means what? As a portfolio manager for your client, you must recommend your client, say, hey, you know what? Your ability is low, so your tolerance for risk is low. Okay. So we're going to move a little deeper into portfolio theory now again. So we call the Sharpe ratio being the return or the portfolio minus RF divided by standard deviation, right? Now, we have this other ratio called the Roy criteria or Roy safety first ratio. So the formulation is exactly the same. However, instead of risk-free rate, remember Sharpe ratio is expected return minus risk-free rate divided by standard deviation. Instead of risk-free, we set a level of return your client wants, like must have. And that would be your safety line. And so I'm going to the next page. So the Roy's safety first ratio gives the distance between expected return and what is expected for a portfolio and what the client requires. So basically what we want is when we calculate the safety first ratio, we want it to be the highest, all right? However, if the RL, which is the level of return your client want, is less than risk-free rate, then you might as well just buy risk-free assets 100%, right? Let's say, what does this mean? It means if RL, what your client want is, let's say, 5% return. However, you know that your risk-free asset is giving you 7% return. Then you might, as a portfolio manager, you must tell your client, use your money, invest in risk-free at 7% return. You don't need to buy any other asset because your RL is less than your risk-free rate, less or equal. So you might as well just fully optimize by you buying risk-free. So this is a small comment again that we talked about. If we substitute the risk-free in the RL, so instead of RL, we use risk-free, it's basically a Sharpe ratio. So it's the same concept, right? It's a risk and reward ratio, but we just substitute the risk-free with RL to give you the Roy's safety first ratio. So the idea at the end of the day, why, okay, so maybe taking a step back, why do you even bother calculate all this ratio? So the idea is we calculate a ratio so that we're able to choose which portfolio to invest in for your client, right? And the Roy safety first ratio gives you the lowest return your client wants. The Sharpe ratio is more generic. You just use the risk-free rate. So we do have a question here to try and explain to you this Roy's safety first ratio a little more. So we are given 3 portfolios here, as you can see, right? Standard deviation, expected returns given as shown. Now we calculate the Roy safety first ratio. We know that your client wants a 3% RL, right? This is RL, right? Because he needs to meet his annual spending rate of 3.5%. So with the Roy safety first ratio, you can plug in the RL as given here, and we calculate your ratios as given. And we want to basically choose the highest Roy safety first, which is a location, location A, 0.4. That maximizes the probability of not meeting the return threshold. Okay, so that's actually all for modern portfolio theory. I know it's quite heavy, a lot of details, a lot of very technical kind of explanation. I really hope that if you do have issues, try to rewatch the lecture. And if you have questions, do not hesitate to email me, and we can see what are your doubts and try to clarify them, because it's really important to understand this modern portfolio theory. So before we move on to the so-called the last part of the lecture, which is the last 1 hour, that's a good question. How do we arrive to the utility of the graph? We need to use the utility function here, this thing here, this equation here. So at the end of the day, the modern portfolio theory is really a basis. So, okay, I'm trying to explain to you why is this even relevant to portfolio management. So at the end of the day, this whole 2 hours explanation of modern portfolio theory is just trying to give you a basis to justify your asset allocation to your client, right? And why? Because we cannot just say, oh, my friends say that we should have 30% risk-free, 30% bonds, 40% stocks, right? You cannot tell your client that, because your client is going to pay you money to invest their money. So they want really concrete proof. They want numbers to justify, right? And so in order to, the modern portfolio theory is like a starting point. It's a starting point for you to determine, okay, at least where I know where should my portfolio be. And then from there, you adjust it accordingly to based on the IPS, your unique factors, what your client wants, etc. Adjust the asset allocation based on those unique factors to meet the requirement of your client. So the starting point of asset allocation is really the modern portfolio theory to give you a basis of where it comes about. Okay, well, why is there this So this is the part that I did not explain. Why is there this 0.005? So this is actually based on the calculation. So if you do a quick search, so I didn't explain it because it's a bit complicated. If you do a search on how do you derive the utility function, is a very complex mathematical explanation on how we get this 0.005. So for the purpose of this course, we just need to know how to use the equation. We don't know how is it derived, but there is a way to derive it. So if you're interested, just do a quick search, you can find. Yeah, it's a constant, but I think the question you might be interested in is why is it 0.005? Why not 0.001 or something? Yeah, it's a constant. So there is a way to derive it. Yeah. Okay, so I really hope that this modern portfolio theory, you are able to kind of understand where this theory fits into portfolio management, because it is not something that we will write in our IPS. We don't write about modern portfolio theory. It's something that you need to know so that you can provide a proper asset allocation strategy for your client. Yes, for sure, you can use it for your own investment. And in fact, a lot of the analysis or parts of the analysis can be derived from Refinitiv. I believe all of you should have access to Refinitiv. It's a platform almost like Bloomberg, and it's really good. So you can use the Refinitiv platform to actually strategize your own investment, right? And I hope from today, the if it's for your own investment, the key takeaway for you, I hope, is that you need to add risk-free assets to your portfolio, right? So if you are already investing in stocks, excellent, but please invest some money in risk-free asset, meaning fixed deposit, treasury, uh, etc., based on what you have calculated on your model portfolio theory. Infinity is, I'm not sure I understand what does that mean, but yeah. Okay, so you know what? Let's take another 7 minutes break. Let's come back at 9:15 before we move on to the last part of our today's lecture on strategic asset allocation. Okay. All right, welcome back. Let's push on to the last part of today's lecture of strategic asset allocation. This part is a little lighter, I would say a bit more qualitative kind of explanation. Next week, not next week, but the week after that, the next lesson, we'll cover more of the quantitative part of strategic asset allocation. So we do a lot of calculations, right? So in this part, let's just think of it more qualitatively, right? So we know that a portfolio of a return of portfolio can split into three parts. It can be the return on the overall market. So we're talking about the beta risk, systematic risk. It can be based on the allocation policies, right? So how much do you allocate in certain sectors, like your friend was talking about different sectors, or maybe even different geography. So these are really affecting how you allocate your asset and the policy behind it. And of course, we do have certain more tactical, more active kind of selection based on market conditions as well. So those are the three splits of where your returns can come from. I'll not go through this, can just read through this, just some explanation, trying to say that most of the time, returns come from strategic asset allocation rather than active trading. Now, so what drives the portfolio return? So generally, the longer your time horizon, the more risk you can take, right? So, and you can absorb more fluctuations in return when your portfolio your thing gets longer. So I do see a question on systematic risk. So this is actually covered in lecture 2A, or actually in year 1, it was covered systematic risk. So I already went in detail what's systematic, what's unsystematic. However, as a quick recap, systematic risk is the risk that cannot be diversified away. They are innate in a stock. It includes risk relating to things like inflation, things relating to market conditions that cannot be eliminated, right? However, yes, that's perfect. Out of control of your investor. Market risk, perfect. So unsystematic risk is the risk that you are supposed to diversify away, and it must be removed, right? So if you are an investor and you do not diversify your unsystematic risk, you will not be rewarded by taking on unsystematic risk. You only be rewarded by taking on more systematic risk. Rewarded meaning more returns. Okay, so there is a good explanation in lecture 2A. However, if you are still in doubts, do not hesitate to reach out to me, or you can review your 203, like FIN 203 slides, because they're covered in your 203 module as well. So to understand, going back to this, so to understand the asset class is important because we need to define what's your correlation, right? When we know we want to achieve perfectly negative correlation, of course that's not possible, but that's what we hope to achieve. The percentage of portfolio in what sector, etc., can drive your returns. Is your portfolio manager active or passive? Generally, if your portfolio manager is passive, you fire your portfolio manager, you just buy whatever your portfolio manager buys, right? So hopefully you notice that in portfolio management, if you are ever a portfolio manager, you must be at least a semi-active or active portfolio manager. If you are just doing passive stuff, your client will just fire you because the client can just invest himself. Okay, so how often you review your portfolio and rebalance. So of course, if you review it very often, you rebalance it might be good because you change your portfolio based on the market conditions. However, we need to be careful that whenever you do rebalancing, there is a cost to rebalancing, right? Cost meaning what? We need to buy certain assets, sell certain assets, and there are transaction fees. There's tax implication whenever you buy and sell, and you realize the gains and losses, right? There are tax implications to realize gains. Of course, tax implication on losses are good for you. right? Called loss harvesting. You harvest your losses for tax purpose. Asset allocation process. So we first need to have a overall market view. What's your general market view so that you can start allocating assets into stock, bonds, real estate. So those that, like I mentioned, those that are in the market now, you know that you should invest in, avoid investing in stocks. Stocks are too high, I would say. Of course, I'm not going to give you investment advice, but if you look at the market, you know that stocks are too high. Bonds are perfect to invest now because we know that the Fed has not reduced interest rates. It has been stagnating for a bit. However, there are some talks about reduction of interest rates in the second quarter or second half of this year, meaning that when interest rates is being reduced, your bond price will increase, right? So now is a good time to go jump to the bond market in case people are interested to jump in. At the same time, we are looking at quite the reduction in interest rate at a more slower process, meaning what? Meaning that if you buy a bond with duration of 2 years and up, at least more than 1 year, it'll be beneficial for you. So view on inflation. So whatever I talked about just now, these are market view on inflation, how things would change. And therefore, if you're a portfolio manager, you should be recommending bonds to your client, right? So I hope that small little tangent that we talk about that I just shared with you about the market and everything, this is exactly what you have to do when you talk about market view. Okay. Market efficiency, do you have some private information? And then, so we have talked about bonds being the asset that you should overweigh in. However, which bonds should you buy, right? So a lot of the times, let's say if I'm portfolio manager, I was like, okay, I think you need to ensure geographical diversification. Let's say most of your stocks are in the US, which is not uncommon because whenever you buy your S&P 500, you buy your tech stocks, they're all in the US. However, perhaps in the bonds, let's focus more on gilts. So gilts are UK-based bonds or UK treasuries. So we can add a bit of European diversification, even though the European market is a bit sluggish nowadays compared to the US. US is still very strong. So we might want to set maybe, let's say, 20% in the UK bonds, and then the rest of the 8% of our bond portfolio in the US, during the US, right? So that's something that you can advise your client based on your market knowledge, etc. And also speed of execution, how fast can you buy the bonds? So we know that the interest rate might reduce in the second half of this year. So if you take a long time to execute, you might lose that window of opportunity to invest in bonds. Of course, there might be some commissions that will impact your returns. So these are some considerations to think about when you talk about asset allocation. Which asset, how much, are we diversifying across different asset class, so that we increase negative correlation. These are some just things to look at: market expectation, any idiosyncratic kind of risk. Do you want to allocate asset based on a thematic approach? So thematic approach means what? That means you allocate asset based on certain themes, for example, ESG stocks, sin stocks, mining stocks. So there are certain themes involved, certain shifting landscape, geographical, technological stocks. So as I mentioned earlier, actually, tech stocks are going up quite high, especially stocks in the AI sector. So if you have this market expectation, you should advise your client on their portfolio to overweigh in AI stocks. So things like Meta, Amazon, Google. So those are like your forefront, your forerunners for technology and AI. Especially Meta. Meta is going up quite well. However, if you have missed the boat already, then it's better to wait for other market conditions. For example, the US presidential election this year, that would usually shock the stock market. So if so stock market more than bond market, because the US election will kind of drive the direction of the country for the next 4 years, right? So having that expectation, you should advise your clients something like, oh, if you're going to invest heavily in the US market, then you need to talk about the US election. If the Republican win, what will happen? What should you invest in? If Democrats win, what should you invest in? So I hope we can see how a lot of market knowledge is being brought into portfolio management in the asset allocation phase. Maybe I'll just pause here. Any questions so far? This is a bit more qualitative, right? So these are some asset classes, the traditional ones, particularly equity, fixed income. So fixed income are your bonds, right? So in terms of equity, you have your various mid cap, small cap kind of companies. Nowadays, people like to do ETFs. However, in ETFs, you need to make sure that you consider things like expense ratio. So expense ratio is how much that ETF is going to charge you for buying the ETF, because they help you create an ETF, right? So they need to charge you a fee. So when buying an ETF, you need to pay a fee for buying the ETF. So such things like expense ratio, what's your tax implication as well. Right, so these are several types of fixed asset. Some alternative classes. Okay, how to determine which stocks? So you need to, so that's where your knowledge of the Republican Party, the knowledge of the market conditions really come into play, right? So typically what people talk about in the market, and hopefully, this is something that you can discuss even in your project work, is that typically where Republican Party wins, a lot of traditional stocks, things like mining, things like transportation generally goes up, because there's usually a lot of ground up support from those sectors, right? Agriculture generally goes up when Republican Party wins, because there's usually more like, depending on policy, of course, the policy, what they introduce, but a lot of these areas are Republican controlled, a lot of, not areas, a lot of provinces, states are Republican controlled, and those states are major drivers of things like mining, right? Oil and gas, yes, correct. Oil and gas as well. That's true. So oil and gas industry usually goes up when a Republican Party wins. Oil and gas stocks. If I'm not wrong, cigarette and tobacco tend to go up as well when Republican Party wins. So there are certain like unique things, right, that you need to consider when certain party wins, because usually these sectors are sectors that really support the ideology of Republican parties. Going on to alternative investment, we do have some things like real estate, private equity, real estate. So REITs are very popular. So REITs provide a good hedge against inflation. However, they are a bit illiquid, but they have regular dividend payment, right? However, as we know, so a bit of the real estate market, hopefully you can appreciate this as inflation goes up, interest rate goes up, usually property prices goes up as well. As we know, property prices are now like at one of the highest. So REITs, maybe at this point in time, not so good to invest in, simply because the prices are too high, right? Maybe when it goes down, when inflation goes down, REITs can be a consideration. So this is something you can advise a client, right? Private equity, generally not listed, a bit hard to invest unless you have certain connections. Collective investment schemes, you can do commodities, hedge funds, gold and energy, generally some assets to invest in as well. So why does inflation drive property prices? Or okay, not rate inflation, but actually interest rates. So generally interest rates, right, drives is driven by inflation. When inflation goes up, we have the central bank has okay. So we will have a full lecture on market expectation, and we talk about inflation. We talk about what should we respond when central bank change certain policies. So increasing interest rate is a fiscal policy done by the central bank to cope inflation. So by doing a fiscal policy as such, generally, because people take mortgages, right? So your mortgage prices would go up, and due to that, your property prices also is being pushed up by your high mortgages that people have to pay, right? So if I'm going to pay a high mortgage and I'm going to sell this property to you, you are going to pay a high mortgage as well, right? Higher the mortgage means the more expensive the property is to you. So do not worry. We'll really go into detail, I think, in lecture 5 on lecture 4, 5, 3, 5 on market expectation. So how do you really form certain market expectation based on various policies? So there are a few risks based on asset classes. So things like equity, you can have a look here. So equity generally is more risky. It follows the business cycle, economic cycle, business cycle. Generally, if you invest in bonds, it helps to reduce risk and provides things like regular payment in terms of coupons. You have gold, which you usually use to hedge against inflation, right? It's a very good asset to invest in. Commodities are generally high risk as well, and typically nowadays they follow the equity market movement. So not too good if you are buying equity and commodities. Of course, it depends on commodities as well. I see a comment. Interest rate affects exchange rates. Now, this is very indirect, yes, but it's more than just, yeah. In short, it's yes, but it's very indirect. So before I encourage you to really research a bit more on how interest rate affect exchange rate. It does, but it's very indirect, and the mechanism is quite interesting. So it's out of the scope of this module, but I encourage you to have a check on research on this. Real estate, good hedge against inflation. However, of course, not good when the interest rates are too high. Alternatives, these include things like ESG, wind power, etc. So generally quite good to get high returns. However, things like investing in a wind farm can be quite illiquid. Okay. So on the question of exchange rate, yes, interest rate inflation can affect exchange rate. However, we need to understand how exchange rate comes about first. Because nowadays, a lot of countries peg their exchange rate to certain currencies. So let's say if the peg of the currencies is to, let's say, the US dollar, then we need to understand the underlying drivers of the US dollar by the US government. So that's why I say it's a yes, there is some impact, but it's more than just inflation, interest rate affecting exchange rate. So a good example in a more Asian context is if you know that the Brunei dollar is pegged to the Singapore dollar, right? You can use Brunei dollar in Singapore. Now, the pegging of such currencies basically makes to a one-to-one exchange. But does that mean that when interest rate increase or inflation in Brunei increase a lot, their currencies would change in terms of the exchange rate? No, because there is a pegging that happens. So I want you to be very careful with exchange rate. You need to really understand underlying drivers, and they are not one-to-one kind of connection. Interest rate increase, exchange rate increase. No, exchange rate is very complex, I would say. So just be careful about exchange rate. So asset allocation, execution, so you need to know how you allocate assets, and usually certain kind of assets can be a bit tough to buy, right? Things like REITs, not so easy buy. Even bonds in Singapore can be a bit tough to buy. It's not impossible. You can buy bonds in Singapore, but it's not so common. Not so common, as in it's not available in all platforms. So you need to be careful when, as a portfolio manager, to know where to get your certain assets for your client. So I already mentioned, need based on prevailing market conditions. Your asset allocation can be passive or active, but if you are passive, you might as well don't help your client manage their money because they can manage themselves. You'll be fired. So it should be active. And importantly, you need to make sure the risk considerations is taken into account, right? So do not give your client 5% return when he only wants 1% return, right? Because they're taking more risk. Asset classes and criteria. So we do have various type of asset classes, and they can either increase your correlation, right? Or increase diversification. And diversification can be in terms of asset classes. It can be in terms of things like different geography, right? Or it can be even things like sectors. What is model portfolio? Where do you see model portfolio? Sorry, do you think you can clarify where is this mod? What is model? Where is the model portfolio? Let me see. Ah, okay, this one. Ah, okay, I saw the model portfolio. Okay, so what is this? So asset allocation can be active, passive, tracking an index or model portfolio. So what does this mean? So I think we'll go through this in lecture maybe 3 or 4. I can't remember. We'll tackle this issue about tracking of portfolio. So what does this mean? It means simply like this. In simple terms, you know ETFs, right? ETFs. So ETFs are tracking certain indexes. They are not actual index. For example, you have an ETF for S&P 500. They are tracking the S&P 500 returns and stocks, etc. So the S&P 500 is now the model portfolio or index portfolio. It's the same thing. So it's being modeled upon. Okay, asset classes, equity, debts. I want to highlight that we should consider debt because a lot of people kind of forget about the bonds as a option. Bonds as an option of asset classes. A lot of people like to focus on stocks, but we should highlight on debts, of course, domestic, international, and there are various considerations here as well. Market expectation, we will go into detail on this, quite detail in this in the next few lectures. Overall, as a just kind of overview, we need to have certain expectations that we talked about earlier. I told you about how I talk about things like interest rates, inflation. So those are all your market expectations, right? So those are things that you consider before you even recommend a asset allocation. So hopefully you can write a nice story to your client. So your client will be like, oh, okay, that makes sense. Oh, well, you have done your research. Then you recommend your product to your client, right? Then you recommend the portfolio. Oh, you should invest in 40% bonds, 20% stocks, etc. So before you even recommend that product, write a nice story first. So you have allocation based mean variance model. Don't worry about this. We will go through this in detail, what this means in the next lecture. Market expectation can be based on things like historical, forward-looking kind of judgment, maybe certain environmental conditions that you notice, some forecasting, usually when you do forecast, when you do uh, forward-looking kind of expectation, usually there might be some errors, so just be careful. Matching of risk tolerance and portfolio. So this is a very typical, if you have already started investing, I think nowadays they make things very simple for you. Things like endowers. So some of you all might have already started investing in endowers. So endowers does this where it's very simple. They just tell you, oh, are you a moderate conservative or conservative? And you just select the options and they help you create a portfolio. So nowadays there's a lot of this kind of services. You don't even have to go into detail, but they create this for you. So it's more and more common. And this usually they provide you like these kind of considerations, and then you just select accordingly, right? Generally, the more conservative you are, the more you want to underweigh stocks, overweigh cash and bonds, right? That's the concept behind. Because stocks are the most risky, bonds are generally less risky. Adding alternatives. So the idea being when you add alternative, you shift your efficient frontier. So that's why we learn modern portfolio theory. So hopefully you can explain this to your client one day that, oh, you should add ESG stocks because you would shift your efficient frontier to the northwest, right? Northwest is where we want to go because that's where your efficient portfolios are. So you shift northwest, and then you get more return for the given standard deviation or risk level. So at the end of the day, there's this thing called alpha, and this is the idea being that you want to search for alpha. Does everyone know what is alpha? What does alpha means? Returns, yes. So it means returns that is not equal to market return, right? Market return is what everyone will get, but you want a return higher than market return. So that's alpha. Okay. So this is where you kind of come in, right? You as a portfolio manager, you're supposed to search for alpha. Can I don't understand? Northwest. Okay, so that's where you need to draw this curve for your client and say, hey, you see, oh, you have this standard deviation here, the risk here, but you get more return. See, you get this higher return compared to this. So you can explain in layman terms. You don't need to use things like Northwest, right? However, what's important to take note is that usually, as a portfolio manager, you have to present your portfolio to your boss first, right? You cannot just say straight away go to the client, I say whatever you want, right? Usually because you do need to present to your manager. Once your manager approves, then you can present to client. So the thing is, when you present to your manager, you do need to use more finance term, right? Because your manager is probably very trained in finance as well, as trained or more trained than you, right? So you do need to use some finance term. Then when you go to your client, you can use layman terms. Oh, you see the portfolio move to the left, and so because left, you see higher returns. You can use things like this. So yeah. Now we need to look at market conditions. So really, market condition is very important. As a good portfolio manager, you need to keep up to date to all your market news. That's why you have Bloomberg News, you have Refinitiv News, basically pushing all the latest updates to you, right? So you need to be very up to date so that we can think about, oh, remember falling interest rates. So I say that second quarter interest rate might fall, and we need to make sure we follow the central bank's strategies, right? So if you're a good portfolio manager, you read into the central bank documents, prospectus on what they are planning to do. However, a lot of people are saying that central bank, even though for this quarter they are not decreasing rates, they will decrease it in the future because rates are getting too high. People are feeling the pain of paying a lot, and um, it has to be done, right, to cope inflation. However, there's still some talks because of the COVID stimulus. So I hope most of you have some background in this, in the sense, does everyone know why the inflation is so high? Does everyone know why inflation is so high? Why is there this whole big issue of inflation and everything now? Like, just as more like general knowledge. Anyone knows? Yeah, but rate hike came later, right? The rate hike is to cope the inflation, but why did inflation go so high? Anyone? Yeah, okay, okay. Yeah, okay. Some people know. Yeah, that's good. So COVID people save too much, then post-COVID spend too high. That's true. Yeah. And also a lot of governments, including Singapore government, actually gave out a lot of solidarity packages to people. So there are a lot of money floating around during the COVID period, which to some extent has not been consumed by the market. Consumed by market meaning what? Yeah, stimulus packages. So people have a lot of money, right? So we have more money, inflation happens. What's inflation? Inflation, okay, so we'll have a whole discussion about this, but inflation is basically too much money chasing the same product, right? So this happens when, for example, I'm buying a shoe. I have a lot of money chasing the shoe, mean that more and more money will keep on chasing this shoe, will push up the value of the shoe, right? To buy. So maybe initially $100 can buy this shoe, but there's so much money chasing the shoe price keeps going up. So that's called inflation. So that's right. And the central bank put a interest rate hike to reduce the amount of money chasing the same product, right? When interest rates goes up, people pay more for interest, people are poorer, they do not have so much money, and so the less money is chasing this shoe, and therefore, when less money chase the shoe price drop. So this is a layman term. That's usually how I like to explain inflation and interest rates, right? So knowing that actually at the moment, um, I think especially in the US economy, there is still a lot of stimulus savings that people have not used yet. And so because of this, inflation is kind of stagnating. It's high, but it's not going down, even though interest rate is high. However, we need to go back to historical data where we see that if the government cuts interest rates too quickly, because now it's very high, if they cut it too quickly, we might see a reverse in the trend, right? Meaning inflation will go out of control again. So by having such market view, we are able to derive a certain asset allocation. That's what I'm trying to stress at. So I think we have a question, what market paper provides all the information? Unfortunately, there isn't a market paper. The best platform I would say is Refinitiv because it's okay, so best I think is Bloomberg, but I think for the purpose of this course and also your access, I know all of you have access to Refinitiv and it's really good. Like for me, I still use Refinitiv as a good news platform to get my daily dose of market updates. So I like this idea of thematic play. So thematic play, I want to highlight again the focus on AI technologies. If we Refinitiv, so REFI, Refinitiv. I'll just type it out. Okay. So when the economy slows down, you go into more defensive stocks. This is kind of makes sense, right? You go into stocks like utilities, maybe even stocks like medical, right? So kind of based on the market conditions. Okay, so some key challenges, just want to highlight to you that increased correlation, especially things like commodities, comps. So we call it comps, commodities or comps, where there is increased correlation between commodities and equities. And therefore, commodities used to be a good diversification strategy. However, now not too good. Maybe you should focus a bit more on real estate, bonds, etc. Increased volatility as well, mostly in terms of stock market, bond market, the inversion of the bond yield curve. So those that are, I'm not sure if there's a fixed income or bond class, but those that have the knowledge, you know that the inversion of a bond yield curve is quite detrimental. It means that a recession is going to happen, right? And then we did see some inversion in bond yield curve. However, we avoided the recession based on very tight fiscal policy imposed by the central bank. So these are something that we need to think and discuss and talk about as well. So the bond yield, right? Bond yield curve. So if you're interested, I'll encourage you to just do a quick Google on the bond yield curve for 2023, and you'll see a very interesting diagram and explanation as well. I'll not go through this. You just say it can be passive or active. Nothing too important. Last but not least, we think about the as the identifying a company based on a top-down or bottom-up approach. So these are two different approaches. So a top-down approach, basically, we look at the economy, right? So whatever we talk about, like economy, or the inflation, the sectors that are doing well, sectors that are not doing well. So we look at the whole economy and we determine what to do. Now, this is a top-down approach. A bottom-up approach is where we look at a company. We identify a company, okay? We say Meta is going to do well. Okay, identify a company, and then we find market conditions, historical data to justify why we think Meta is going to be doing so well, right? So this is a bottom-up approach. Generally, top-down approach is preferred because we want the market to direct our investment, not our buyers of certain companies to direct our investment, right? So a top-down approach is usually encouraged. Can we predict recession? Yes, there are many ways to predict recession. And one of the ways that earlier I mentioned is the bond yield curve. So when the bond yield curve inverts, that's where a recession generally would happen. However, there are some exceptions, and this business cycle or this economic cycle is very unique. So I hope that maybe in your group project, you can highlight some of these things that we talk about, especially the big economic cycle that we are in, because it will be very relevant to answering your group project well. All right, so that's all I actually have for today. We will talk about optimization in the next lecture. So I think I'll pause for now. Any questions so far? I know today it's quite heavy in terms of the content because modern portfolio is a little tricky. It's a bit tough to understand. But I'll pause here. Any questions? Any comments? Maybe if you think that it's too heavy or you want me to repeat certain part in the next lecture or go slower. I hope it's not too fast. Everyone is able to keep up the pace. Okay, I think the frontiers we have explained a few times. Okay, you know what? How about, because the portfolio frontier we can't explain a few times, how about you look through the lecture 2A, and then look through lecture 2B. If you do have issues, we can go through the frontier again. So in layman terms, the frontier is basically the best selection of the portfolios in terms of risk and rewards. That's important. The best selection of the selections, meaning there are many portfolios on the frontier, the best one for the given risk and reward. Um, yeah, Refinitiv, yes. So if you have a bit of troubles understanding, I encourage looking at Bloomberg. So I think everyone knows YouTube. So go to YouTube, Bloomberg News. So Bloomberg News actually does a very good um, explanation because it's a video, right? So usually the economists on Bloomberg News on YouTube kind of dissect the information for you, explain in very layman terms. So if you do have issue with uh, reading or understand the very technicalities of market papers, look at Bloomberg News. So Bloomberg News on YouTube, right? So this they publish their news every day, of course, and it's quite interesting to give you a good understanding on the market conditions. So I think that's all I have for you. Final reminder on your GBA groups, do reach out to your group mates so that you know that they are in the course and they are going to do the group project with you. I'll say that the group project is quite heavy. If you notice, it's a high percentage, it's quite heavy. So you need a full group. You cannot do it by 2%. You'll not do well. Okay. So please make sure that you have a group. Oh, sorry, I think I checked. Let me just put everyone. Please make sure you have a group. Reach out to your group mates. And if you have issues, do reach out to me. Okay, because the group project, again, I repeat, it's quite heavy. You need to write quite a bit, so you need a full group to do it, right? Or at least 3% if you don't have a full group. I have that's all for you. I'll see you in 2 weeks. Those that have not watched lecture 2A, you must watch it. It's not optional. And that's all I have. Hope you have a great weekend ahead. Thank you for your time. Yeah. All right. Goodbye. Thank you. Have a great evening. Good night as well. It's a bit late. Pause the recording.